All right. So, you sent this over, and it was VCI Properties earnings report, right?
Yep.
And there was kind of like this reaction in the market.
There was.
And so we're going to take a deep dive into this today and kind of see if there's something here that we need to be really worried about, or if maybe this is like a
Is this a real
real opportunity,
red flag, or is it a buy the dip opportunity?
Exactly. Yeah.
Because VCI Properties, they own a lot of very prominent real estate.
Yeah. They're huge.
Yeah, some of the most iconic properties on the Las Vegas Strip.
Like if you've been to Vegas, you've probably been in one of their proproperties.
Oh yeah, absolutely.
Yeah.
Caesar's Palace, MGM, Grand Venetian.
Right. So they're a big deal, and when their earnings report maybe doesn't meet expectations,
right?
People are going to notice.
Absolutely.
But is it really something to be concerned about, or is this, like you said, a buy the dip opportunity? So
right, and that's what we really want to dig into today is separate, like the accounting noise from what's actually happening fundamentally with the business.
Okay, well, let's jump into it then.
Okay, sounds good.
So where do we even begin with this?
Well, I think a good place to start is with the way that VCI structures its leases.
Yeah.
They use something called triple net leases, and it's a pretty crucial part of their business model. So let's talk about what that is and what it means for VCI and potentially what it means for you if you're considering investing in them.
Okay, triple net leases. So like imagine, they own these huge properties, right?
Right.
But they don't actually run the casinos or the hotels.
Yeah.
They're like the landlord.
They're the landlord.
And so they have these tenants, these big companies that actually run those venues.
Exactly.
And a triple net lease, it's not just like, hey, you pay the rent.
Right.
The tenants are actually responsible for a whole lot of the costs that usually come with like owning a property.
Yeah. So on top of the rent, they're also paying for things like the property taxes, all the maintenance, the repairs, even the insurance.
Wow. So it's like...
It takes a lot off of VCI's plate.
Yeah. It's like, if you had roommates and they took care of everything.
Exactly.
You just sat back and collected the rent check.
Yeah. So for VCI, this means that they have a really predictable flow of cash coming in. It takes a lot of the risk out of the equation. Running a massive resort like that can be very complicated.
Right.
Lots of moving parts. But with triple net leases, they can kind of just sit back, collect that rent, and know that a lot of those operational headaches are being handled by the tenants.
Okay, and these expenses, like the taxes and the insurance, they tend to go up over time, right?
They do, yeah.
So how does that affect VCI?
Well, that's the beauty of the triple net lease structure. Those increases in expenses are typically passed through to the tenants.
Oh, so VCI is protected.
Exactly. It's a built-in inflation hedge, if you will.
So even as things get more expensive, VCI's income stream is still pretty stable.
Right, and that's something that's really attractive to investors, especially in the current economic environment.
Yeah. Okay, so that's a big plus for VICI. But one thing that I've always heard about them is that they're very concentrated in the Las Vegas market, which, it's Vegas, it's exciting, but it's also kind of risky, right?
Yeah, that concentration risk is something that people bring up a lot, and it's a valid concern to consider.
Right.
But I think it's important to look at how Las Vegas itself has been evolving. It's not just about gambling anymore.
Right. It's not just the casinos.
Exactly. I mean, think about it. They've got the Raiders. Now they've got the Golden Knights, the Aces WNBA team Formula One races.
They had the Super Bowl this year.
They did. They hosted the Super Bowl. It's become this huge entertainment hub.
Yeah, it feels like Vegas is making a real effort to be like a destination for all kinds of different events.
Absolutely.
Awesome.
And that's a really important shift because it means that the revenue streams that are tied to VCI's properties are becoming less dependent on just the gaming industry.
Okay, so it's not just people coming to Vegas to gamble.
Right. It's people coming for concerts, for sporting events, for conferences, all sorts of things. And that diversification is a really good thing for VCI.
So it's almost like the more diverse Vegas becomes, the less risky VCI's position is.
Exactly. It's this kind of secular tailwind that's pushing them forward.
Okay, that's interesting because a lot of people see that concentration as a negative.
Right. But I think it's important to dig a little deeper and see how the underlying market is changing.
Okay, so we've got the triple net leases, which protect them from inflation. We've got the diversification of Vegas, which helps mitigate that concentration risk.
Yep.
But what about their leases themselves? Like, how long are these tenants locked in for?
This is another really impressive aspect of VCI's business model. Their average lease term is 41 years.
41 years?
That's incredibly long.
That's longer than most mortgages.
It is. It's unheard of in most industries, and it gives VCI this incredible level of stability.
So they know they're going to have these tenants paying rent for decades.
Exactly. They have this very clear line of sight into their future cash flow, which is a huge advantage in a world where things are constantly changing.
Right, because businesses, they come and go.
All the time.
But VCI has these tenants locked in for the long haul.
And it's not just the length of the lease, it's also how these leases are structured.
Yeah.
Many of them have built-in rent increases that are linked to inflation.
Oh, so it's like that triple net lease protection, but even on top of that.
Exactly. It's like a double layer of protection against rising costs.
Wow. So even if inflation stays high, VCI's rental income should keep pace.
Right. It's a really powerful mechanism for preserving their purchasing power, and that ultimately benefits their shareholders.
Okay, so we've got the lease structure, the length of the leases, the diversification of Vegas. All these things seem really positive.
Mm-hmm.
But then we've got this earnings report.
Right.
And the market didn't seem too happy about it.
No, they didn't. And I think this is where things get really interesting.
Okay, so what happened?
Well, VCI reported FFO funds from operations of $0.58 per share.
Okay.
Analysts were expecting 67 cents per share. So that's a miss.
Yeah, that's a noticeable miss.
It is, and it's understandable why the market reacted the way it did. But the key here is to understand what drove that miss.
Okay, so what was it?
The primary driver was a non-cash accounting adjustment related to something called the CECL provision.
CECL.
Current expected credit loss.
Okay, that sounds complicated.
It is a little technical, but essentially it's an estimate that companies have to make about potential future credit losses.
So it's not like they actually lost money.
No, it's not about cash flowing out of the business. It's more like setting aside money for a rainy day.
Okay, so like if you're a homeowner and you might need to replace your roof in a few years, you might start putting some money aside each month just in case.
Exactly. It's prudent financial planning, but it doesn't mean that your roof is leaking right now.
So VCI was essentially being cautious.
Yes. They increased their CECL provision, which reduced their reported FFO. But it's important to remember that this is a non-cash charge. It doesn't reflect a decrease in the actual cash flow that their properties are generating.
So the headline number looked bad.
Right.
But the underlying business was still doing well.
Exactly. And if you look at some of the other metrics in their earnings report, it paints a much more positive picture.
Okay, like what?
Well, their adjusted funds from operations AFFO, which is often considered a better measure of a REIT's cash available for dividends, actually increased year over year by 5.4%.
Okay, so more cash.
More cash, and AFFO per share rose by 3.6%. So the core business is still performing well.
So it really does seem like the market might have overreacted to that FFO miss.
I think so, and this is further supported by what happened with Moody's.
Moody's, the credit rating agency.
Yes, they actually upgraded VCI's credit rating from Bay 1 to Bay 3, which puts them into investment-grade territory.
It's a big deal, right?
It is. It's a really significant vote of confidence from the credit markets.
So Moody's is saying that VCI is in a really strong financial position.
Exactly. They're saying the VCI has a very high likelihood of meeting its financial obligations going forward.
And this investment grade rating, does that have any practical implications for VCI?
Absolutely.
Right.
It usually means that they'll be able to borrow money at lower interest rates in the future.
Oh, okay, so it saves the money.
It does, and it gives them more financial flexibility.
Yeah.
They might be able to use that extra cash flow to pay higher dividends or to invest in new properties.
So it's kind of ironic, right?
It is.
The market is freaking out about this accounting adjustment, but Moody's is upgrading their credit rating.
It really highlights the difference between short-term market sentiment and long-term fundamentals.
Yeah, it's like two completely different perspectives.
And I think for investors who are focused on the long term, it's important to pay attention to those fundamentals.
Okay, so we've talked about the leases, the Vegas market, the credit rating, but what about inflation? You mentioned earlier that VCI has some protection built in.
Right, so a significant portion of their leases have these rent escalators that are linked to the consumer price index, CPI.
Okay, CPI. So as inflation goes up,
their rent goes up.
So their income is keeping pace with the rising cost of goods and services.
Exactly. It's another layer of protection for them and for their investors.
And how much of their rent is currently tied to CPI?
Right now it's around 42%, but they're projecting that it'll increase to 90% by 2035.
90%. Wow. So almost all of their rent will be adjusted for inflation.
Pretty much. And that's a huge advantage in this environment.
Yeah, especially for income investors who are worried about inflation eroding their purchasing power.
Exactly. It's like a built-in hedge.
Okay, so we've got all these things working in VCI's favor, but what about their dividend?
Yeah, so they have a solid track record of paying dividends and consistently growing them. Their 5-year compound annual growth rate is 7.73%.
That's pretty good.
It's very healthy, especially considering the rate of inflation we've seen recently, and it suggests that they're committed to returning value to their shareholders.
And that dividend, is it well covered by their earnings?
Yes. Their AFFO comfortably covers the dividend, and as we discussed, their cash flow is very stable and predictable thanks to those long-term leases.
So it seems like a pretty reliable dividend.
It does, and the fact that they're consistently growing it is a really positive sign.
Okay, so let's talk about valuation then.
Sure.
The information you shared included some valuation models.
It did. Yeah.
What did those models suggest?
Well, one model, a comparables valuation model, suggested that VCI's intrinsic value is around $35.38 per share.
Okay.
And another model, a dividend discount model, came up with an even higher fair value of $37.40 per share.
And the current stock price is?
Around $31.53.
So both models are suggesting that VCI is undervalued.
They are. And it's important to remember that no valuation model is perfect, but the fact that both of these models are pointing in the same direction is definitely interesting.
Yeah, it suggests that there might be some upside potential here.
Exactly. And the information you shared also mentioned the possibility of future interest rate cuts.
Right. How would that affect VCI?
Well, when interest rates go down, income-generating assets like REITs tend to become more attractive.
Why is that?
Because investors are always looking for yield. And when the yields on safer investments like bonds go down, they start looking for alternatives.
Okay, so if REITs are offering higher yields than bonds,
they become more appealing, and that can drive up their stock prices.
So if interest rates do go down, that could be another tailwind for VCI.
Exactly. It's something to keep an eye on.
Okay, so last thing I want to touch on is the comparison to broader rate ETFs, like VNQ.
Right. So VNQ is a very popular ETF that tracks a wide range of different REITs.
So it's like a diversified basket of real estate investments.
Exactly. You get exposure to office buildings, retail spaces, apartments, industrial properties, all sorts of things.
And how does that compare to investing in VCI directly?
Well, VNQ offers diversification, which can be a good thing, but it also means that you're exposed to sectors that might not perform as well as VCI's specific niche.
Right, because VCI is focused on those entertainment properties in Vegas.
Exactly. And those properties have those unique triple net lease structures.
Yeah.
And they're benefiting from the growth of Vegas as an entertainment hub.
So if you believe in that specific story,
then VCI might be a more compelling investment than a broad REIT ETF.
Okay, so it really depends on your investment goals and your risk tolerance.
Exactly. There's no one right answer.
Yeah.
It's about finding the investments that align with your specific needs.
Oh, yeah. Okay, so let's sum this all up for our listener who's been following along with us.
Sure.
What are the key takeaways here?
I think the biggest takeaway is that the market's initial reaction to VCI's earnings report was probably an overreaction.
Because of that accounting adjustment?
Exactly. The CL provision.
Yeah.
It created a lot of noise, but it didn't really change the fundamental strength of the business.
Right. And those fundamentals seem pretty solid.
They do. They've got those long-term leases with built-in inflation protection. They're benefiting from the growth of Vegas. They've got a solid dividend, and their credit rating just got upgraded.
So it seems like the market might be missing the bigger picture.
I think so. They're focused on the short-term noise and ignoring the long-term potential.
And that disconnect could create an opportunity for investors who are willing to do their homework.
Absolutely. If you believe in the VCI story and you're looking for reliable income and long-term growth, this could be a good time to take a closer look.
So our listeners probably wondering right now, is this a buy?
Right.
Is this a buy the dip situation?
And that's a question that you'll have to answer for yourself based on your own research and your own risk tolerance.
But we've given you the information you need to make an informed decision.
We have, and hopefully we've helped you to see beyond the headlines and understand the real story behind VCI properties.
So thanks for listening. And remember, don't just react to the news. Do your own research.
Absolutely.
Think for yourself.
And always invest responsibly.
Exactly. Thanks for joining us.
Thanks for having me.
We'll see you next time.
See you then.
On The Deep Dive.
The Deep Dive.
Dive.